Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the 40th episode of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we've done this podcast a lot lately. You've had glasses on, and for those that look at this, we do share this on our YouTube channel, Carson Group's YouTube channel. Your glasses are no longer on you. I feel like I can see you again. You don't look as geeky. I mean, you know, that's I don't know if it's good or bad. Sometimes I feel better when you look geeky because I know you're really getting into that data. So how are your eyes doing, man?
It's I think allergy. It's getting warmer, so allergy season's over. I'm not rubbing my eyes as much. I think so I can put my contacts back on. It's interesting. You said, we're on YouTube, and suddenly it struck me that, this is, they're actually showing our faces here. Mm-hmm. For good or worse. I like your shirt, by the way. I like the summer look.
So, we're down in Charlotte. I was at Myrtle Beach last week. I only brought so many shirts because I just thought I'd be more laid back, and I didn't want to wear the exact same shirt I wore last week on the podcast. It's like the only other shirt. Okay. It's quite summery. But so we were in Myrtle Beach last week, and I went swimming in the water, like this big, I don't know how to explain it, like this big bouncy house thing on the water. Anyway, long story short, I got some water in my right ear. I still cannot hear out of my right ear. Like 3 days later, I'm putting drops in and stuff. So I've got these headphones on, but
I had that when I was flying. I was flying and I had allergies, and I was traveling to Boston. I think that was just a couple of weeks ago, and my ears just wouldn't pop. And then I was meeting some folks. I had to go up like 20 floors or something like that, which didn't, it was like coming down from the airplane. The ears didn't pop, and then you're going up 20 floors in a closed elevator. So I hear you. I feel you.
Yeah. Well, the next time I'll be on a plane is in 2 weeks. You and I will both be in Omaha to talk about our mid-year outlook, which we'll talk more about. But lots of fun stuff. So hopefully my ear pops by then, because I know that can be very, very uncomfortable. All right, everyone. So again, welcome to Carson's Facts versus Feelings, episode 40. We're already thinking, 50 is not that far away. We got to do something special. We're calling this one The Summer Rally Has Legs. You've listened to us for a while. We've been talking about a surprise summer rally. It's happening. We're going to talk more. We'll talk about that in a little bit. But we're going to
be a summer T-shirt. Like you should get a T-shirt. Summer Rally Has Legs.
There you go. Hashtag. But we're going to start off with the discussion of hard versus soft economic data. I think we talked about this, 3-4 months ago approximately, but talked about the idea of hard data, which is what you want to follow, being stronger, and soft data, the surveys continuing to just look at the end of the world coming. What does that all mean? We'll talk about that. And then we'll definitely talk about the summer rally, a little bit of the weakness we've seen in June, why we think the second half of this year potentially could still be good for investors. We remain overweight in the Carson house view models that we run here at Carson Group. And we're going to finish things up with a discussion on housing. We've talked a lot about housing, but Sonu, you saw some recent economic data. You did a great job yesterday with our partners on a morning call, looking at all the different housing data that says, listen, maybe just to upset everybody, we might be closer to early cycle than late cycle when you look at some of the housing data. Well, first things first, Sonu, hard versus soft data. Let's just take it from there. What does that mean? What is hard versus soft data? Then we're going to dive in.
I think the simplest way to understand it, hard data is data that is production data. Like, let's just say industrial production. The Fed measures that they're actually talking to companies saying how much they produced, right? In terms of volumes, right? That's an example of hard data. Employment. Now, employment is actually, interestingly, these are surveys, but these are such massive surveys, right? We've talked about the payroll numbers that comes from something called the Establishment Report. They survey, I think, about 150,000 businesses or something like that, right? It's massive. Now, and then you have like retail sales. Again, that comes from, the Census Bureau. They take these measurements and measuring, how much are people actually spending on cars and restaurants and bars and things like that. Then you got the soft data, which is, these are much smaller samples, right? Much smaller surveys. Yeah. Maybe, you all have heard us talk about the PMIs, right? Purchasing Manufacturers Index, Purchasing Managers Index, I should say.
Close enough. Yep.
So you have that for manufacturing, you have that for services. And what they do is ISM does this as well as S&P Global. And they go out, survey about, I think about 150, 300 firms. So it's not a lot, right? And they're asking the managers, you know what? Did you see your new orders increase or decrease relative to last month, right? And there's the NFIB. Don't ask. Oh, you know what? I think I actually know what that stands for. National Federation of Independent Businesses. So, before you tell me, Sonu, what does NFIB stand for? But they have the small business survey, right? That's another survey. They're asking small businesses, okay, what are you seeing in terms of prices? What are you doing in terms of hiring? Are you seeing business activity increase, decrease, things like that, right? So that's basically the difference between hard versus soft data.
No, great stuff there. I mean, Bert White was on stage last September at our big annual conference called Excel, and he talked about the difference between kind of how people feel versus kind of what they're doing, right? We've talked a lot about last week. We talked about retail sales strong, the consumer strong, jobs are strong. Yet, if you look at a lot of this confidence surveys, like we just talked about, people aren't feeling that great. But interestingly, if you ask someone, hey, how do you feel about your job and the confidence you're going to have that job in 6 to 12 months? It's like the highest it's ever been. So people are quite comfortable with their employment, which is obviously very important, yet they don't feel that good. And I don't know how to describe that other than it's what we're seeing. You can blame the media, you can blame social media. Maybe some of that plays in there, but it's first, follow what people are doing. So let's just take a look at some of the hard data that just came out like before we did this. I don't know if we had a ton of time to look at this, but durable goods just came out across the board really strong. So that's like the real hard data that's happening versus those ISM surveys, which are surveys that continue to say, we're not too sure about things. Now, what did you think? I know you haven't had a ton of time to look at that durable goods, but did you get much of a chance to dive in?
I'm literally staring at it right now. So this is, again, a good example, as you said, of hard data, right? Mm-hmm. Census Bureau asked manufacturing firms, okay, and so, how much have you guys shipped? But more importantly, how much new orders are you getting, right? These are new orders for, let's say, metal products, machinery, computers, electronic products, electrical equipment, aircrafts, big deal. Yeah. Automobiles, big deal, right? So I'm just looking at this, right? Aircraft orders, right? Usually these things are volatile. Aircraft orders can be volatile. We shouldn't complete, and so we always look at data excluding aircraft, and that's because it's volatile. But just for a moment, Ryan, and this is data for May, new orders for aircrafts increased, and this is non-defense aircrafts, think of your Boeings basically, right? Mm-hmm. That increased 33%. 33%.
Now, is that month over month or year over year? What's that 33?
That's month over month.
I assumed it was month over month. Wow.
Yeah.
Wow. Yeah. Well, that's volatile, but wow.
It's volatile. And it's that's an insane number. It just goes to show more people. You were just talking about flying, right? People are flying everywhere. The global airline industry is seeing demand. And so they're ordering more planes. Now, of course, it's not like you order a plane today, you get it tomorrow, right? But they're ordering planes because they see the industry is going to do, I assume, fairly well for the next decade, really. I mean, because if somebody orders a plane today, chances are they're not getting it for another 5-6 years or whatever, maybe even longer, right? But the new orders are coming in. That's a great sign. But now, take that apart, right? Because you said that's volatile, right? That can move up and down a lot. But we have this thing called new orders for capital goods, right? Business spending, basically, excluding defense, excluding aircrafts. That was
is this the one that flows into GDP? I always get confused in this. There's one that flows into GDP. Is it
some of it flows in. Yeah, it's this one. And think of it as it's business investment, right? It's business investment. That was up 0.7% in May. That's huge. That's 1 month, by the way. If you
much better than expected too.
Yeah. If you annualize that, that's like 7 to 8%, something like that, right? So between 6 and 8%, depending on whether you're looking at 1 month or 3 months or something like that. But all this to say, that's really positive, right? Business investment is going up. We were talking about soft data, by the way, and we'll get to the whole sentiment piece. Joe Weisenthal at Bloomberg, he flagged this this morning. He sends a nice report out every morning. So the Dallas Fed does a survey as well. These are like your regional PMI index, right?
Yeah. So and these are wildly volatile. These regional surveys, they're wild. Yeah.
So they've all been negative, right? They've been negative for several months, maybe for about a year, because it goes back to sentiment. Sentiment has been poor, but he pulled out a fascinating nugget from, and these reports have comments from the people they survey. They don't survey too
Mm-hmm.
many people, but they have a few comments. So I'm going to read this whole comment because it's fascinating. Because he said, this is from a company in the computer and electronic product manufacturing industry. He's saying, we continue to struggle to find qualified staff. We intend to hire more people and embark on significant capital improvement, including new building, new manufacturing equipment, so that we have capacity available as soon as the economy starts to recover after the recession that everyone is predicting. So it's like, we are going to invest because we want to be, normally if there's a recession, what does everyone do? Businesses pull back. Now it's like, wait a minute, everyone's predicting a recession. Okay, but we don't see it yet. Everyone's predicting it. But you know what? We are going to gear up to be ready for the upswing. So everyone's almost spending to prepare for the recovery after the recession. And because of that, it's ironic. We're kind of not getting a recession.
No, and we've had a lot of new listeners to the Carson Facts versus Feelings podcast, and just a lot of old listeners know this, but Sonu, our team, specifically a lot of the macro stuff you look at, came into this year saying likelihood is no recession. Of course, there's a chance we could have one. But we said we don't expect one, and the data continues, I think, to confirm that. So, one thing you shared, I believe, and you'll correct me if I'm wrong, I think it was a report from Goldman, but they took a look at like 19 different factors, and they looked at all the different things. You take it from there, because you talked about it yesterday. Hopefully I set that up okay, but it was fascinating, this hard versus soft data. Take it away.
Yeah, no, Goldman put out this really interesting research. This was last week. So they have a composite survey tracker because, like you just said, these regional PMIs that the Dallas Fed, Philly Fed, New York Fed, all of them put out. That's very volatile, right? So they combine all of it. They combine 19 of these, as you said, into a composite. Now,
was that right? It was 19? It was 19?
Yes, it was 19.
Hey, I should go buy a lotto ticket. I was guessing on that one. Yeah, okay.
Those are the numbers that stick with you when you write a blog post. Like 19, here are 19 things to make your life better, or here are 13 things Mark Wahlberg does when he gets up in the morning, or something like that.
I'm guessing it's push-ups, sit-ups, and runs 10 miles if it's Marky Mark. But
So anyway, coming back to Goldman. Yeah. So right now, that composite tracker, which combines all of these things, that's saying recession. And it's been contracting since February, right? So the last several months, it's been saying, oh, we're going to see a recession. Now, ironically, that actually doesn't make sense because we know from GDP, domestic demand, if you take out the volatile parts, inventory and exports, things like that, just like domestic demand, how much are households, government, and businesses spending, that was up 3% in the first quarter. Right now, for the second quarter, it's tracking about 2%. So they were like, okay, let's rank these 19 survey sentiment indicators, basically, right?
Yep.
And they found the top 5, the best 5 are your ISM, S&P Global PMIs. Philly Fed Index was a top one too. If you just take those 5, right, the top 5 out of the 19, there's a 52% chance that growth is below 1% this year, and a 35% chance of negative growth, recession, right?
Okay.
But here's the thing. They said, the predictive power of these surveys have gone down since the pandemic over the last few years.
Right.
And this has happened in the past, and that's usually when there's some factor or the other that causes sentiment to go down. And that distorts survey responses. People just feel negative, going back to what you said and what Bert's been talking about, right? Bert White, our chief strategy officer here at Carson.
Yep.
So usually sentiment falls when there's more uncertainty, potentially large downside risks. Last couple of times this happened was 2011, 2013. We had a few debt ceiling standoffs. We had fiscal cliff standoffs, tax cuts, no tax cuts, tax increases, all of that, right? Then 2018, 2019, you remember the trade war, the tariffs and all of that?
Oh, yeah.
That was a time when businesses started feeling, like there was poor sentiment among, purchasing managers, all of that. But there was no recession, right? That was 2 periods when there was a disconnect between the hard data and soft data. And turns out the hard data actually, turned out to be right. And, right now, I think that's where we are. The hard data is showing that things are okay, maybe slightly better than okay. I think it's still okay. Let's say the economy is growing around 2% on trend, right? But the soft data is telling us that, oh my God, we're in a recession or very close to one. And that's part of why I think everyone's calling for a recession, even earlier this year, right? Everyone's saying, oh, there's going to be a recession. HSBC just put out a report today saying there's definitely going to be a recession before the end of this year, right? There's only 6 months left, but yeah, they seem quite convinced that you'll get into a recession. Why are they all predicting a recession? Because most of the models have these sentiment indicators,
Right.
and all of them are pointing to contraction. I think that's where you have to look at both, I think.
No, fascinating. And again, I know we did discuss it several months ago, and some of this feels like
Yeah.
we already talked about this, which is the soft data maybe isn't telling the true story like the hard data. The LEI, leading economic indicators, it's gotten a lot of pub negative 14 months in a row, one of the longest streaks of being down month over month ever. Historically, when it's down like 6 months in a row, you've had a recession like every single time. But our friend Tom Lee at Fundstrat pointed out there's three big components to LEI that he thinks is kind of, I don't know how I want to word this, kind of, showing the wrong path, so to speak. There's a large consumption of consumer, a large part of it is consumer expectations for business conditions. ISM surveys of new orders are in there, and the yield curve inversion. So those three things are a big reason why. And some of those are kind of sentimenty, kind of, maybe not always hard data versus the hard data being strong. I mean, we've really, I think we've hammered this home pretty good, but I want to finish on LEI because we hear a ton about it. Literally turn on TV. I can guarantee, hold your breath. By the time you breathe again, you probably heard someone on TV talk about the LEI being bearish. Okay. So no, like in 2 minutes, let's wrap this up, but tell me about the LEI and, kind of maybe our version of the LEI. I know we talked about that before, but why it might be flawed.
Look, the LEI is the leading economic index. It's put out, the most popular one is put out by the Conference Board. And a lot of it, they have about 10 to 12 indicators in there. A lot of it, two things, right? They have a lot of soft data in there. And we just talked about, why soft data may be pointing to something, different than hard data. A lot of soft data. And then it's also geared towards the manufacturing sector. And manufacturing, as you know, makes up only about 12% of the economy. Consumption accounts for 70% of the economy. So you have to look at the labor market, you have to look at retail sales, auto sales, restaurant purchases, all sorts of things, I think, to get a better picture of what's happening in the economy. And that's basically what we do with our own version of a leading economic index. We have our own one too. I've written about this. Ryan's tweeted about it as well. I mean, we
talked about it a week or two ago also.
Yeah,
we did talk about it recently.
We account for the fact that, exactly as I said, 70% of the economy is consumption, and you have to account for that. Right. And we have a mix of both. Like, I'll give it away, right? We do have the Philly Fed index in that, right? But it's only part of it, right? We have a lot of other things too, right? And I think that, at the risk of sounding immodest, I mean, I think it captures the dynamics of the U.S. economy a little better than the Conference Board's LEI.
Absolutely. I tend to agree. So great discussion there. We spent probably half the podcast talking about this, but I think it's such an important concept. We've got about 15 minutes to go. We'll talk about the stock market kind of in July and June, where we are in a minute. Harry Markowitz passed away recently, I believe last week. So by the time someone listens to this, you've put together an amazing blog, a tribute to him and just kind of the impact that he's had, honestly, on you, as I read it, but our industry in general. Honestly, if it's on you, it's kind of how we view the world here at the Carson Group and the Carson Investment Research Team as well. I mean, don't I guess take as much time as you want, but talk a little bit about Harry Markowitz, how he changed our industry, and how you think what he talked about 30, 40, 50 years ago still matters today.
Totally matters today. I think it's ever so grateful to him, and may rest in peace, right? So he passed, and Nobel laureate. He got it's actually not the Nobel Prize for economics. It's a Swedish central bank. I'm gonna butcher the way it's actually pronounced, but the Swedish central bank's economics prize in honor of Alfred Nobel. So it's not technically a Nobel Prize. The Nobel Prize in economics, by the way. Did you know that, Ryan?
That is confusing. My head just exploded there.
So anyway,
you know what? We'll say he should have got one. Maybe he should have got a Nobel Prize.
Yeah,
he got something.
He is a Nobel laureate, right? So
okay,
he is a
there we
Nobel
go.
laureate. So period. So anyway, coming back to essentially his work basically formalized diversification and its benefits. I think that's the best way to put it. He quantified it. He showed the benefits of it. I think all of us knew about diversification in a way. I mean, I'm not saying we weren't alive in 1950s, but most investors did, right? You hear things like, don't put all your eggs into one basket, right?
Yes.
Yeah, obviously diversify, right? But he actually formalized it. He quantified it. He showed that, look, portfolio risk, when you think about an entire portfolio, it's less dependent on the riskiness of individual holdings. What matters more is how they correlate to each other. One zigging, is the other zagging, or is it moving in the same direction? So you can't view any investment return and risk by itself. You have to view it within the context of the overall portfolio. It's almost like, okay, if I put a new investment into my existing portfolio, does it move together with everything else, or does it move a different way? Right? And that matters a lot. So what he was saying is you can construct a portfolio of different assets with a higher return, but without a higher level of risk, right? So he's basically the one who taught us about this return versus risk framework, right? And interestingly, he's one of the first to talk about behavioral finance as well, how people feel the pain of loss more than the joy of an equivalent return, right?
He was first to discuss that, really.
I mean, he was one of the first.
He was
one of the, he talked about, he talked about that. I mean, that was formalized later by, Professors Kahneman and Tversky in the 70s, but he always talked about it. So how you frame
just jump in just for a second. Let me just jump in just for a second. Just for a second. I traded options for 11 years, right, at a shop. Did that. I can tell you probably like my 5 worst trades ever. I probably can't even think of my 5 best trades or even my 2 best trades. It is 100% true. I can't make 100%. We can't make guarantees, but it is likely very true. We remember when bad things happen in our investments in our life versus so many good things that happen. Literally, like as we speak, like the internet in the house I'm in isn't really working. So I just popped on a hotspot. Like that's a really good thing. It wasn't that big of a deal. I'll forget it happened tomorrow. But I mean, just think about how amazing that is. But anyway, I jumped in there, but it is true how we remember the negative so much more than the positive, which just how we're wired.
No, and that's why framing, when you talk about a new investment, how you frame it when you're talking to somebody else, that matters, right? Whether you approach it in the way of, you have so much to gain versus you have so much to lose, right? And once you talk about loss, people are like, oh my God, maybe I don't want to do that, right? Because they're valuing the loss as much more, I think at least twice as more than an equivalent gain. And coming to, people remembering loss, we're just talking about soft versus hard data and sentiment, right? I think, look, one thing that's happened since the pandemic is it's as if everyone's muscle memory is negative right now. We've just gone through COVID. It is. And then last year for markets, like for those of us who invest and stuff like that, last year was horrible, right? Stocks are down, bonds are down. It was a terrible year. So are we like wired to think, when is the next shoe going to drop? Right. I think that happened after the 2008 crisis. For several years, people are bearish, right? People are like, when is the next shoe going to drop? Yeah, the Greek debt crisis. Yeah, the Italian debt crisis. You get one after the other. Yeah, China. And I think it was only by 2017, 2018, people started feeling positive. 10 years later. And now then the pandemic hit. And we've had a tough year last year. And I think it's like I said, a muscle memory to be negative. Right. And so you have to look at
fascinating discussion.
A lot of things could go right.
Yeah, well, and they have been, and they will. But you're right. But great discussion. Definitely rest in peace, Dr. Markowitz. Definitely a true titan in our industry. So let's move forward though. We've got 2 things we wanted to talk about in the next 10 minutes or so, and I'll kind of lead this first one. I'm just literally going to look at a tweet that I just did. So we had this summer rally. We talked 3 or 4 weeks ago about the idea maybe we could have a summer rally. June could be strong. We've had a really strong June. Stocks did finally last week fall for the first time in 5 weeks on the S&P, 8 weeks on the NASDAQ. Listen, historically, the 3rd week of June isn't very good for stocks. A little break makes sense to us, but July is right on the corner. Just think of this, everyone. The last 10 years, July is the best month on average. It's higher than 9 of the last 10 times. Pre-election years, July does well. Since 1950. July is pretty strong. Usually summer months, you're talking June, August, September-ish, aren't that great, okay? But July is that bounce period. We think the potential with the realization economy is still strong. Earnings season is going to kick off in July. Probably going to have better earnings once again as the hard data is better than the soft data. And we think it can continue. But Sonu, here's what I want to point out. In all likelihood, we're going to be up at least 10%. For the year, right at the end of
the week,
into June, and the end of the week, into June. So your median year, the final 6 months gains about 5%. All right, but when you are up at least 10%, the median, the final 6 months is 10%. All right, The median's 10% higher 82% of the time. That's when you're up 10%. Now, here's the real kicker. And again, I saw this on Twitter. I think FundStrat actually might pointed out. So I did it myself. When you're negative the year before, like we were, so you're down the year before, and then you have a good start to the year, up at least 10%. The next 6 months, median return 12.4% higher 89% of the time. Now, these are just, I can slice and dice these numbers. You listen to this podcast, you heard me talk about a lot of numbers like this. A lot of them have been saying, hey, we're going higher, and that's been happening. But Sonu, I think it's really fascinating, and why we likely remain overweight equity. We are overweight equity. It's probably going to stay there. That the second half of this year, we could still see a continuation. What about 13% for the year? Will we really gain 13% the second half? Maybe not. But, to think that we could see solid high single-digit gains the rest of this year, maybe a tad more if we get some good news. It's not as abnormal, as crazy as it sounds. Again, we want to finish with housing, but anything you want to add on the idea that this summer rally has legs or the second half of this year?
I think, folks, there's your mid-year outlook preview from Ryan, right? I mean, but I always like to think, I'm a big believer in momentum, right? A lot of the work you do, I think, points to that. I mean, momentum's worked. I think there's a famous paper, like, momentum's worked for like 150 years. And now it's probably 180 years or something, because that paper came out 30 years ago. But momentum begets momentum. It's literally what you talked about. Stocks were down last year, then it bounced. It was up, if it's up more than 10%. The odds are it's going to be up even more over the last 6 months of the year. I think that's the long and short of it, to be honest.
Exactly. And I do have another one. So when you're negative the first 6 months of the year, so if you're down, which thankfully we're probably not going to be that way this time. We were last year at this time. The next 6 months do much worse. You're talking median return of 2%, higher about a coin flip at the time. And we saw some of that last year where we were down heading into, at the end of June. And then obviously it wasn't that great. Had a big sell-off. Did have a big bounce into the year. But you know what I'm getting at. The bottom line is, things still, macro picture still good. You could argue valuations are a tad stretch. Sonu, I didn't think I'd ask you this. Let's talk just briefly about valuations, X technology, because you pointed this out to our advisors yesterday with some help from our friends at Wisdom Tree, because we hear valuations are high now, and they are higher. Sure, they're higher. Stocks have gone up. But X tech, what does it look like?
So valuations for the S&P is running about, it's slightly above its 30-year median, and our friends at Wisdom Tree, kudos to Jeremy Schwartz. He's got this data for me. Forward PE, right? If you take price over forward earnings for the next 12 months, that's running just under 20 times, right? The median is about 17 or something like that. But if you take tech by itself, and it's not just the tech sector, because it's tech sector plus Amazon, Netflix, eBay, Etsy, things like that. That's about 28 times forward earnings, right? Versus the 30-year median for that group is about 21 times, forward earnings. So you can see that there's a big overvaluation there if you want to think about that way. By the way, that group makes up about 37% of the S&P 500, right? So it's a big chunk of it, right? It's more than a third. But if you take the rest of it, 63%, right? S&P excluding that expanded tech sector, that's trading at 16.7 times forward earnings. And that's right at the 30-year median. Right. Wow. So there's no overvaluation there. And it gets to something you and I had talked about. We like, sectors like industrials, for example. Right.
Yeah, I know small caps are historically cheap relative to large caps, industrials, financials, energy, some of the cyclical areas. Those areas aren't nearly as overvalued or stretched. Now, let's be honest, tech's had an incredible run. We know that. That's probably why the valuations are where they are. But again, if you're concerned about some of the valuations, we're more even weight technology the rest of this year. We think that this market's going to broaden out. It's not just going to be tech communications that are leading. Some other sectors are leading. I mean, just yesterday, and believe me, we need to wrap this up and get moving. But just yesterday, NASDAQ was down 1%. S&P was down. Dow was down. Yet small caps were up significantly. I think it was like 9-4 advancing stocks versus declining stocks. If all you saw was the headline, the market was down, and look, tech was down. Listen, NASDAQ had a huge run. So a 1% drop isn't that big of a deal, in my opinion. It's just that rubber band was stretched. But there was a lot of internal strength just yesterday. This is Monday. We record this on Tuesday. On Monday, on a bad day, a red day, 9 stocks going up versus every 4 going down. You didn't know that unless you looked under the surface, where small caps did a lot better in some other areas. All right, Sonu, let's talk briefly about our upcoming, I guess, is it next? Jessica joins next week? It's all a blur. When you wear a shirt like this, you're just kind of going through the motions. It's summertime, you're having fun. So Jessica Golson from our team is going to join Sonu and myself. And Sonu, give a little preview about some of the cool stuff that we're going to talk about with Jessica here. This will be we're going to record it this week because of the holiday. We will have a regular scheduled podcast. I guess it'll be the 5th, right? I guess the 5th, July 5th. So when that'll come out with Jessica. What do you think we're going to talk about?
Jessica, I like to think of Jessica. Jessica, just so that everyone knows, she
Yep.
leads our investment research team, right? And
Yes.
and he has a good way. I was trying to think uh, what's a good way to explain what she does. She's like the Wizard of Oz behind all of it. She's the one who makes everything tick. She makes everything go,
Yes.
right? If you pull the
Right.
curtain, like Jessica's there, nothing gets done without.
Yeah.
Like I can say I like this investment. Ryan can say, oh, yeah, I like stocks. We overweight this thing. But he say, you know what? We want to use that fund or that strategy. How do we do it? How do our advisors get access to the stuff Ryan and I talk about and manage portfolios? Jessica's right there, right? She's the one who makes everything tick. She's the one who makes everything happen.
Yes.
She's fantastic about that. She's got, I think, a very interesting journey through finance as well. So really excited about having her on the podcast and talking about the Carson Investment Research Team.
Yes, absolutely. I know we're going to have some meetings, talk about what we're going to talk about on the podcast, but I think you're going to really enjoy next week's podcast, getting into the kind of peeling back the onion, I guess, so to speak, and kind of what makes our team tick and some of the really cool things we've got coming out and just kind of how we see things, like you said. And she was recently promoted and absolutely well-deserved there. So
yes,
definitely going to be a fun conversation, a fun podcast. And also, I guess, a lot of people have July 4th coming up. So we'll wish everyone a happy July 4th holiday weekend for sure. Sonu, we kind of are literally at the end, but we'll take a couple minutes and go over. Hopefully people don't yell at us too much.
All right.
Housing. We have talked a good deal about housing, I think, but there's been more data. You've done some amazing daily notes for our advisors here at the Carson Group, more than 350 advisors at the Carson Group. You've done some blogs on housing. I'll set it up and then hand it to you. What we're seeing, and I love to talk about permits and housing starts, it almost looks like off the lows, the big bounce we've seen, it almost looks like early cycle. And that makes bears' heads explode when you tell them we're seeing early cycle signals. And sometimes I just like to say that to see their heads explode. Nonetheless, let's talk briefly, maybe 5 minutes or so here on housing and why it's such an important part of where GDP is going to go and the economy is going to go.
This is like a take 5 for housing only.
There you go.
We'll have to start doing this for different sectors of the economy. Just take 5 stocks, take 5 housing. No, before I scare off our producer here, Chelsea, kudos to her. So, but yeah, housing, right? So you have to separate it into two pieces. There's the single family side, and there's a multi-unit, multi-family side of the condos, rentals especially, right? But let's talk single family stocks. They've historically led recessions, and usually why has that led recessions? The Fed raises rates, housing immediately gets hit because mortgage rates go up, right? We saw that last year. Single family stocks got crushed, right? And housing dragged, Ryan, about close to 1%. It took away from GDP last year.
Yeah, I believe 1%.
Something like that.
Or a lot.
Yeah, a lot, basically. So then usually what's interesting in past recession, the Fed cuts rates, and then single family starts are usually the first to recover because, rates go down. People still have to buy homes at the end of the day, right? And the people forming new households, people get married. Right. And we've seen this dynamic in the last 5 recessions before 2020, going back all the way to 1980, 81, and all of that. But now what's interesting, the Fed's still keeping rates high. They're not cutting rates. And you and I are of the opinion they're not going to cut rates anytime soon. But we're seeing starts improving a lot. Starts jumped 19% 1 month, right? 19% in May. They're up 24% over the last 6 months or so. Permits, right? These are, builders go to get permits authorized to start new construction. That leads housing starts. That was up 5% in May. So these are numbers you usually see only during recessions. Now, it's not a big surprise because home builders have been very positive, right? Over the last several months, you and I have
the strongest group, you could argue. Maybe there's one stronger, but there are very few stronger than what home builders have done. I will just chime in. That 19% jump in housing starts expected to be down, like only fractionally, but I mean, talk about missing the mark.
Here.
Up 19% expected to be down. I mean, oh my goodness. What's Warren Buffett's quote? If you got one economist, you've got one too many employees, I guess. That's a good one there. No, exactly. You're a macro thinker. I'm a macro. I say I play economists on TV once in a while.
There you go.
But the other thing, Sonu, GDP. How do I want to say this? Housing took away from GDP 8 quarters in a row. I don't know if that's an all-time record, but it's one of the longest streaks ever. Now, with some of the things you're talking about here, do you think that's in the rearview mirror. Now housing is going to add to GDP. And is that something, honest to goodness, maybe our friends at RenMac are saying it. I haven't heard too many people talking about the potential positives that housing could bring, not just the rest of this year, but we're talking 2-3 years out. These things trend, right?
No, absolutely. I think it's like you said, it's taken away from GDP for 8 quarters in a row. Over the last 3 quarters, it took away a lot just by itself. If it doesn't take away anything, that's a big deal, right? If it adds, it's zero, right? But I think it could add a little bit too. And then, so suddenly we swung from negative to positive. That's a big, big deal for the economy, right? And, it comes back to demand. The problem is there aren't enough homes, right? Most of us, I was reading a statistic, I think 62% of homeowners have mortgage rates less than 4%. Now, if you think about it, if they sell their home and if they have to buy a new one, they get a mortgage rate closer to 7%. How many people are going to do that unless you have to, right? I'm not saying people have to move, they'll buy a home or they rent. But most people will be like, you know what, I'm not selling my home. Because of that, we don't have any inventory of existing homes. So we have a massive cohort. We actually have the largest cohort of 25 to 34-year-olds in America.
Sonu, time out for a second. We've done this podcast 40 times now. That could be the first time anyone's ever said cohort on the podcast. Yes. I mean, you never know what you're going to get on the Facts versus Feelings podcast.
I didn't even have that in my notes. It came off the top of my head. Yeah. But we have 46 million people in that 25 to 34-year-old cohort. They're all potential home buyers. I'm not saying every single one of them will buy a home, maybe not even half. But, that's a lot of potential home buyers, right? There are not enough homes on the market, right? The inventory of existing homes is just about 1 million units. Back in 2007, we had 4 million units.
Wow.
Right. And we have more people now. We have much more demand. So you can see a lot of these people are being pushed into the new homes market. And that's why home builders are feeling good.
Great discussion there. So again, this is the 40th episode of Carson's Facts versus Feelings. We titled it "The Summer Rally Has Legs." We talked about hard versus soft data. The hard data continues to suggest economies on much better footing than the surveys, and the soft data talked about the potential for the surprise summer rally to continue, have legs, and then that great housing discussion there. We did mention Tom Lee, fund strategist, did just mention RenMac. We might have some special guests. Not to give anything away there, but we've got some guests coming up here over the next month or so.
We talked about valuations
really cool
as well.
Guests.
Valuations as well. And we have somebody special to come in and, somebody who's worked on it for a long, long time. So we won't give it away.
Beyond special. Yeah, we like doing these when it's the two of us, but we also have found people like when we have a guest. So we're trying to find that happy medium. I'll just say that. But we've got some really big name guests coming on this podcast over the summer. We'll just say over the summer that we think you're going to like. Well, Sonu, we've definitely gone a little long. I think hopefully people enjoyed this conversation. Any final comments from you? Then I'll bring us home.
No, I think I think housing is a big deal, and then manufacturing as well. Right now, I think again the soft data points one way, but I think the hard data, we've talked about it. Semiconductor plants, electric vehicles, that's a big deal. There's something happening, something really positive happening in America right now with manufacturing. So between those two things, in addition to the fact that employment is still strong, I think we're in a good place.
And what a great time for good things in America to be happening, because again, July 4th is right around the corner. So everyone, thank you for listening. We've hit a lot of downloads, a lot of likes, a lot of follows, a lot of positive comments on this podcast. We're going to keep doing it as long as you keep listening to it. So we really appreciate that. We wish everyone from the Carson Group, Carson Investor Research Team, a happy and safe July 4th. You always hear those bad incidents with fireworks. You big fireworks guy, Sonu? I mean, last thing. I mean, you into that type of stuff?
I love watching it. I'll do sparklers with the kids, and that's about the extent of it.
Yeah, like I said, I can't even swim without water getting in my ear, so I think I'm going to have to avoid fireworks. I'll watch them as well. But everybody, definitely have a great holiday. We're looking forward to next week again with Jessica. So if you're taking next week off, put that in your queue and listen to next week's Facts versus Feelings as well. That'll be a really special one. So we'll see everyone soon. And again, have a great holiday. Take care. Goodbye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.